So good morning. I'm Robert Rich. And as Paulo said, I'm going to talk about the Fed's dual mandate. And here's the outline of the discussion I'm going to provide. The basis of the Fed's mandate, a little historical perspective, where it came, how it evolved. Then I'll talk about the objectives, maximum employment price stability, and then also talk about a new item in the Fed's communication strategy, the FOMC statement of longer-run goals and policy strategy. And then we turn to a more practical question. Okay, so now that we know what the objectives are, how do we actually achieve them? Okay. So, for example, maximum employment price stability, we know that these goals typically are complementary, but not always. And so what we have to think about now is, again, how do we actually achieve these objectives? So I'm going to talk a little bit about the labor market, talk about the natural rate of unemployment and cyclical unemployment. Then I'll turn to differentiating between headline and underlying measures of inflation, because we'll see that's also going to be important. And then I'll talk a little bit about a simple model of the inflation process. And then finish up with, again, as Paulo pointed out, performances versus objectives. Take a look at our recent performance in terms of how we have or have not met our goals. And then talk just very briefly, because a lot of other presenters will talk about this, the introduction of thresholds. Because in the course of introducing thresholds, there will be references to inflation and unemployment, but I want to be very clear how they're being used and whether they're actually, and to be very clear that they're not in any way changing what the dual mandate happens to be. So let me actually begin by providing a little bit of background information on the dual mandate. So in democratic societies, the ultimate goal of a central bank is to promote the public good, and it does so by fostering economic prosperity and promoting social welfare. But for the U.S., the central bank has more specific objectives that have been established by the government. So the mandate in the U.S. was originally specified in the Federal Reserve Act of 1913. Okay, that actually established the Federal Reserve System and actually gave responsibility for conducting monetary policy to the Fed. But in terms of its tasks, it was somewhat vague. The Fed was really asked to provide what was called an elastic currency. What does that mean? Well, it basically means a currency that you would sort of raise and lower as economic conditions warranted. Eventually, the mandate was clarified by an amendment to the Federal Reserve Act of 1977 as part of the Humphrey-Hawkins Act. And this was, in some sense, intended to make the Fed more accountable for its monetary policy actions. And this mandate then was, according to the legislation, to effectively promote the goals of maximum employment, stable prices, and to moderate long-term interest rates. So I hope this is my clicker. It is. So I'm giving a presentation on the dual mandate. Dual means two, and yet there seems to be three items up here. So I haven't had that much coffee, but there's a reason for this. And the reason is because, in some sense, moderate long-term interest rates can only exist in a stable macroeconomic environment. And to have a stable macro environment requires actually maximum employment and stable prices. So in some sense, these first two items are a prerequisite for the establishment of the third objective. And hence, we now move to the dual mandate, that is focusing on the first two items, full employment and stable prices. So the aforementioned goals of maximum employment and stable prices are often called the dual mandate. And I want to be very clear about what this means. And so I've tried to highlight, again, the notion of independence and differentiating between goal independence and instrument independence. So to be very clear, the Fed is not goal independent. The goals of maximum employment and stable prices are determined by Congress. That's part of the mandate, especially in 1977. However, the Fed is instrument independent, meaning the choice of how to achieve the goals of maximum employment and stable prices is determined by the Fed. So in essence, Congress sets the goals, but gives us operational independence to achieve those goals. Okay, so let me turn now to the first of the components of the dual mandate, maximum sustainable employment. Now, it's very important, and you'll hear other speakers talk about this, that when we talk about the labor market, that long-run employment and output are determined by non-monetary factors. It's very, very important to understand this, and I'm sure this is something you're well aware of. In the long run, employment is determined by factors such as population growth, technological progress, preferences for saving, risk, and work effort. You don't see anything that's monetary in there. Another way of saying this is that long-run employment is determined by factors that influence labor supply, labor force participation, and labor demand. These are not factors that are typically in the area of monetary policy. However, we know that in the short run, the economy goes through business cycles. There are variations, right, in utilization rates of factors of production, so that we observe changes in utilization of labor and capital. So output and employment can fluctuate above or below these long-run levels. And the goal of monetary policy, or one of the goals, is then to help smooth these short-run or business cycle fluctuations and thus stabilize the economy. So again, monetary policy in terms of maximum sustainable employment seeks to mitigate the deviations of employment or output from its full employment or potential level. And we'll come back to this because we'll talk about things like unemployment gaps or output gaps. Let's turn to the second objective, price stability. So what's the definition? What do we mean by price stability? Well, one way to think about it is to draw upon a quote from former Chairman Greenspan, in which he says, think of price stability as an environment in which inflation is so low and stable over time that it does not materially enter into the decisions of households and firms. Okay? Now, why is it that price stability is important? Okay? If there's enough time, we can go in and actually talk a little bit about the costs of inflation, because obviously there are costs associated with it. But remember that in a market economy like ours, prices are the mechanism that allocate resources. And the ability for prices to act as essentially the signal to ensure that we have outcomes and an efficient allocation of resources, that is enhanced by an environment in which you have stable prices. So the goal here, again, is to remind ourselves that it's really the price system, things done to, in some sense, remove impediments to the price system, things to allow the price system to efficiently allocate resources. That's very, very important. Now, the central bank does have primary influence over the long-run behavior of the general price level, so we can control that. But again, over the short run, policy seeks to mitigate deviations of inflation from its long-run objectives. So again, what is policy trying to do in the short run? Sort of make sure that we reduce these deviations, but in the long run, we believe and can control the inflation rate. Now, this is a new item that was introduced a little over a year ago. I want to spend a little bit of time on it. It's called the Longrun Goals and Policy Strategy Statement. It's part of the FOMC emphasis on improved communication and enhanced transparency. And to preview this a little bit, what you can basically think of this statement as, it's an updated interpretation of the dual mandate. It was introduced a little over a year ago in the January 25, 2012. And it intends to reaffirm and make appropriate adjustments each January. In fact, it was recently amended and approved on January 29th. So as part of clarifying the dual mandate, what the longer run goals and policy strategy statement essentially does is it reiterates the commitment to objectives of maximum employment and price stability. Very importantly, when it was first introduced back in January 25, 2012, there was now an explicit long-run goal of 2% PCE inflation. Right? So the Fed came out and actually defined what it meant by its long-run objective for inflation, 2% PCE inflation. It also, in this statement, talks about, and as I said before, typically the objectives are complementary, but if they're not, the balanced approach to the committee's policy decision when the goals are in fact not complementary. So again, this is being added, but you should think of this as sort of trying to, again, clarify even further the dual mandate. Okay, so we've talked about this in terms of what we're trying to do. Full employment, price stability. Sounds good. How do we go about thinking about achieving those objectives? So these are a series of questions. How do policymakers gauge whether the economy is operating at maximum sustainable employment? How do policymakers monitor inflation developments and assess the outlook for achieving price stability? And then what sort of model underlies policymakers' thoughts about the inflation process? And that's where I would like to now move to. Again, so now I want to think about, as a policymaker, the practical aspect of this. We know what the goals are. How do we go about actually obtaining those goals? So let me begin, first of all, with the concept or the term full employment, and begin by sort of telling you what it's not. Full employment does not mean an unemployment rate of 0. Okay? So labor market equilibrium can coexist with a positive inflation, with a positive unemployment rate. Okay? And then in terms of assessing full employment, we're going to need many indicators for this assessment. So while the unemployment rate will be a key indicator, it is not, in fact, the only indicator that we will use to assess full employment. Now, I mentioned before that full employment does not mean the unemployment rate is equal to 0. What we really mean by full employment is the unemployment rate being at its natural rate. Okay? And in fact, there are two sources for a natural rate of unemployment for any economy. First is what we sometimes call turnover unemployment or frictional causes. Now, the labor market and economies are very dynamic. Right? And as you see, lots of things are changing. Jobs are continually created and destroyed. Workers are continually entering and exiting the labor market. Ultimately, what you want to do is get the best match between employer and firms, and that takes time. So search unemployment is part of this. The idea, again, is some positive unemployment, if you're thinking about unemployment involved in getting the best match between workers and firms, is actually good for the economy. So one of the sources for the natural rate of unemployment is turnover unemployment, or sort of what they call sort of frictional unemployment. There is, however, also another component, more structural, which is based on mismatch unemployment. And I'll talk a little bit more about this in the next slide. This comes about because, again, you may have a situation where current skills of some workers may not match opportunities for longer-term employment skills. So recently, if you have a sector that's contracting, those workers with those skills are needing now to try to match in other sectors. That may take time. There's a mismatch between what those skills happen to be. Another issue that's been particularly important recently is this idea of reallocation of labor from shrinking industries or depressed regions to expanding industries or booming regions. This is actually, sort of workers moving across the country. Okay? And there's been a lot of talk, as we'll see shortly, about the impact of this in light of how perhaps workers have not been as mobile because of, for example, their housing situation, because they may be underwater. They can't move as quickly. And go and seek out those opportunities. But you can think of both skills and location as contributing to mismatch unemployment. And these two, turnover and mismatch unemployment, are part of what's referred to as the natural rate of unemployment. Now, the word natural, again, is a little bit of a misnomer. So I think it's really, really important to emphasize this very first line here. One drawback, and one thing I'll talk about, is in spite of its importance, the natural rate of unemployment is not directly observable. It has to be estimated, and there are econometric models that are used to try to estimate what the natural rate is. So not only must you estimate the natural rate, but in any type of estimation, you recognize there's some imprecision associated with that. So the natural rate of unemployment is not directly observable. You have to estimate it. You have to recognize that even if you have an estimate, there's some imprecision associated with it. But it gets even more fun, which is that the natural rate of unemployment can actually vary over time. So you have an object which can move over time. You can't directly observe it, and it can be imprecisely estimated. Okay, so far so good. Now, what's also important is to understand what types of policies can and can't influence the natural rate of unemployment. Government policies can influence the natural rate, but this lies largely in the domain of legislative action. Okay, the natural rate of unemployment is not something that monetary policy can act upon. Again, we can try to fill in the gap between the unemployment rate and the natural rate, but the natural rate itself lies outside the domain of monetary policy. As I mentioned before, one of the things that we are trying to understand right now is that while we observe the unemployment rate, we're trying to figure out how much of that is cyclical, that is associated with the business cycle, how much of that is actually the natural rate. That's a really important question for a variety of reasons. Recently, with the Great Recession, trying to get an assessment of how much of that is, whether there's been a change in the natural rate, we know that their skills have deteriorated from increased unemployment duration. We know, again, that there's been impeded labor mobility due to weak housing market. So we think there may have been a change in the natural rate. We think it may have increased, but we're not sure exactly how much, what that magnitude happens to be. Cyclical unemployment, then, is simply the difference between actual unemployment and the natural rate of unemployment. And again, this is what we think monetary policy tries to fill in. Okay? So positive or negative when the unemployment rate is above or below the natural rate. So let's actually go now to a picture to see what we're talking about. The red line is the civilian unemployment rate. The blue line is an estimate of the natural rate of unemployment from the CBO. Again, I haven't put any sort of confidence bands around this, but just recognize that it has sort of evolved slowly over time. And as it stands right now, with the unemployment rate at about 7.9% and an estimate of the natural rate, again from CBO, that I believe is in the range of maybe, say, 5.5%, this would be the current estimate of the cyclical unemployment. Okay? And again, this gap is sometimes referred to as the unemployment gap. But again, I want to emphasize that while the red line is observable, the blue line is not. It has to be based on an estimate of a particular model. And monetary policy is effectively trying to essentially move the red line down towards the blue line. But monetary policy is not it has the ability to actually move the blue line. Okay. Now let me turn to the question of inflation. Okay. And I again want to talk a little bit again from the perspective of a policymaker, from a practical standpoint. How do we think about achieving price stability? Okay. The first thing to simply recognize is that we're going to look at two different concepts of inflation: total, and then underlying inflation. I'll talk a little bit about what those particular measures are. It's important to begin by recognizing the fact that when we observe price changes, there's always a mixture of permanent and transitory price changes. All right? That just happens to be the case. What policymakers are faced with is the difficult task of trying to figure out how much of a price change is permanent and how much of it is transitory. So as a policymaker, you don't want to respond to what will ultimately turn out to be a blip. So if you see a rise in inflation and it turns out to be temporary, you don't want to undertake a policy action that's going to sort of result in a contraction in demand. Likewise, if you see a decline in inflation and it turns out to be temporary, you don't want to go ahead and sort of provide accommodation for that. So the key to that is again, to try to differentiate between the observed or headline inflation rate and then some underlying inflation rate. So underlying inflation, as we'll see shortly, is effectively a tool to help us differentiate transitory and permanent changes in prices. Okay? So again, it's critical for policymakers to differentiate between these two. And what I'll show you shortly are various measures of underlying inflation that are designed to extract and essentially remove transitory price changes to essentially give you a better reading of sort of what the underlying rate of inflation happens to be. Okay? So again, you don't want policymakers to respond to blips. And what we really are interested in is we know that if we undertake a monetary policy action, there's a lag effect in terms of when it impacts both output and inflation. So we want a better measure of sort of the trend in medium-run inflation. And these measures of underlying inflation are essentially intended to do that, because it turns out these measures actually have better predictive accuracy for movements in medium-term inflation than headline inflation. Now, the last point before I go to pictures here is a point that I think is somewhat overlooked, but I really want to emphasize this. The underlying measures of inflation that I'm going to introduce to you will all involve excluding some types of items. You're probably familiar with the ex-food and energy measure. I'll introduce and talk briefly about a trimmed mean or a weighted mean. These underlying measures of inflation are going to exclude certain items. What's really critical to understand is the Fed does not exclude these items because we don't care about them. Remember, our ultimate goal is headline inflation. What's really important to understand is the underlying inflation measures are a means to an end. So when, for example, we talk about movements in, say, for example, inflation, ex-food, and energy, we care about the fact that people have to pay for food. We care about the fact that people have to pay for energy. We recognize that. We look at an ex-food and energy measure because it provides a better gauge of where inflation is going. It's not that we don't somehow think people don't have to pay for food and energy. So the biggest takeaway point, even though it's a sub-point here, is underlying inflation measures are a means to an end. They are not an end of themselves, Okay. So what are the types of underlying inflation measures? So the measures that you look at basically depend critically on where you think these transitory or temporary movements in prices take place. A long-standing view is that most of the temporary changes in prices occur with food and energy. That's one view. So if you think that most of those kind of movements tend to be temporary, and you exclude those from your underlying inflation measure, and that's the very common or well-known ex-food and energy measure. But that's not the only measure of underlying inflation that we look at. We also can look at two other types of measures. One's called a weighted median and a trimmed mean. And basically, in this viewpoint, you don't associate temporary price movements with particular items. You associate them with where they're located in the distribution of price changes or in the tails. And the belief here is that when you observe either very large or very small price changes, that those are viewed as being temporary. So a weighted median and a trim mean essentially is a way of taking all the price changes, you order them from lowest to highest, and then you go about effectively weighting each of those items by their expenditure share, and then you exclude or trim a certain amount to come up with a measure of underlying inflation. In the case of the weighted median, it's the 50th expenditure percentile. In the case of the trim mean measure of inflation, you throw out sort of the top 7% and the bottom 7 or 8%. But again, these are just alternative ways of trying to get at a measure of underlying inflation. Okay? So what do they tend to look like? Well, here's the total CPI, and here's the CPI ex food and energy. And really what I want to draw your attention to is somewhere around 1986 here. I'd like you to look at, as it's moving up and down, the difference between how the red and the blue lines move before 1986 and afterwards. And what you can see prior to 1986 is that effectively the ex food and energy measure sort of ends up trailing but following the red measure. But after 1986, there's a slightly different behavior between the series. You'll notice then that while the red line is sort of moving up and down, the blue line tends to be a little bit smoother. So you don't have core inflation sort of tracking headline inflation. In a couple of slides, I'll show you a measure of long-term inflation expectations. But I'd like you to think about, in the background for this particular picture, the fact that long-term inflation expectations and their anchoring has a lot to do with the change in the behavior between these two series. Okay? Now, how do these other measures of underlying CPI inflation look? So again, I've just simply put up those three measures I talked about. The ex food and energy, the median, the trimmed, and you can see while there are some differences in their movements, they generally track each other fairly well, so they are generally giving you the same picture. Again, the idea of using these particular measures is to give us some idea of where overall inflation is heading. Again, a means to an end. Let me briefly talk about the inflation process. Present a very simple model, a very simple way that I think about the inflation process. I think about it as sometimes referred to as a triangle model of inflation. There are three components: an inertial component, an activity gap measure, okay, we'll define those, and then supply shocks. Again, the takeaway point from this, again, is when talking about inflation, understand that inflation is effectively affected by three factors. So you need to take into account all three factors when you're thinking about where inflation is heading. You don't want to simply focus on one of those factors. So the inertial component, what does that mean? Well, one of the things that we know about inflation is that it tends to move very slowly over time. So a way of thinking about the inertial component is if someone wants to know where inflation will be tomorrow, a good starting point is where it is today. And that's all that the inertial component means. It's a very fancy word of essentially saying where you are today. Okay? Now, why is it that inflation tends to deviate only gradually from its past values? As we'll see, we have a slow adjustment of inflation expectations. They're very important. And as we'll see shortly, this importance of well-anchored inflation expectations is consistent with the objectives of price stability. So as I'll show you a picture shortly, we monitor long-term inflation expectations because we think it's very important for explaining where inflation is going to be, and it's for anchoring. There's also wage and price contracts in the economy that tends to keep inflation from moving very rapidly. So that's the first component, the inertial component. Now, remember that picture I showed you between the two measures? Again, go back and take a look at this picture. And what you can think of is, remember how core was tracking total? Well, look how long-term inflation expectations are moving. And yet, as long-term inflation expectations came down and has become relatively well anchored, you'll notice that core inflation tended to move very little, and yet headline inflation was moving up and down. So behind this, in terms of core inflation and its movements, we look at long-term inflation expectations. So one of the explanations for why the change in the behavior between the two series has taken place is because we've now observed, since basically 1997, an anchoring of long-term inflation expectations. Okay. How am I doing for time? Okay. The second component I'd like to talk about are what are referred to sometimes as activity gap measures. Okay, this is the second component. This is sometimes thought about as giving a gauge of resource utilization, telling you something about the balance between supply and demand in an economy. Okay, so I'm going to go through and give you some very powerful acronyms because you're not going to hear enough acronyms over the next 2 days. So it's time to give, might as well start off the acronyms right now. The key is at full employment, there's no inherent tendency for inflation to accelerate or decelerate. So at full employment, or when the unemployment rate is at the natural rate, there's no tendency for inflation to rise or fall. What are activity gaps? Activity gaps are measures used to gauge demand pressures relative to some notion or some full employment in the economy. So as I've mentioned to you before, we can talk about the current level of unemployment relative to the natural rate, or first acronym, the NAIRU. We also then can measure excess demand or excess supply pressures in the aggregate economy by looking at output relative to potential or natural rate. This is called the output gap. And although it's not used nearly as much, there used to be a time where we would look at capacity utilization relative to some estimated value called the non-accelerating inflation rate of capacity utilization, or NAIRCU. But again, what you need to think about here is these are all defining an observable relative to an unobservable. The natural rate is unobservable. The natural level or potential output is unobservable. The NAIRCU is unobservable. But it's trying to tell us in the economy right now, do we have excess demand or do we have slack? Supply shocks. So supply shocks are a little bit like luck. They can be good or they can be bad. Okay. Inflation can be influenced, as we know, by external factors that result in sharp changes in business costs. So we need to account for the fact that there are external shocks that hit the economy. Now, what we do at the Fed, I shouldn't say we, what I do is I typically try to measure supply shocks through import prices. You perhaps have seen other people suggest things like oil prices, energy prices, or the exchange rate as a way of modeling external shocks. Okay. I don't do that for two reasons. One, oil prices are difficult to model. They're very volatile. They can be very noisy. Also, exchange rates typically affect the price level in a country because they go through import prices. So you sort of have these linkages, right? Exchange rate to import prices to the domestic price level. I don't want to have to worry about an area of slippage in some sense, that second area of slippage. So I just go directly to import prices and think about how the impact of import prices on the domestic price level. How can that happen? Well, import prices are a component of the domestic price index, so there's a direct impact. But also, changes in import prices can induce domestic firms to alter the pricing of their competing goods in the domestic economy. So that's the other way in which import prices can affect the domestic inflation rate. And what's actually important in determining where inflation is moving is relative import prices, the rate of growth of import prices relative to the domestic price level. Okay. Let me finish up in the remaining time with a couple brief notes. Performance versus objectives. We know what we want to do. How have we been doing it? So you grade students, so this is our way of kind of grading ourselves. The FOMC has fallen short on both objectives of the dual mandate since the Great Recession. So let me talk a little bit about past and current. Inflation has typically been running below the 2% longer run objective of the committee, and unemployment remains too high relative to estimates of sustainable rate. I think Arjia and Krishna and several others will talk about something called the Summary of Economic Projections. These are essentially forecasts that are submitted by both members of the Board of Governors as well as the Fed presidents. So not only have we missed looking at the past and current, but I'm going to show to you that we don't expect to meet our goals of the dual mandate going forward for a few more years. All right? So the idea here is to show you both we've missed kind of in the past and currently, and if we look at the Summary of Economic Projections, we're going to end up not meeting those goals over the next couple of years. What is the Summary of Economic Projections? Let me just very quickly run through this. Again, there'll be much more discussion about this. They're submitted 4 times a year. It started with, in October 2007 with the Enhanced Fed Communication sort of approach. FOMC participants forecast output growth, unemployment, inflation over the next 3 years and the longer run. The SEP, the Summary of Economic Projections, conveys a quantitative assessment of the FOMC's objectives. Okay. So as you'll see shortly, I'll have a graph after this, that basically the longer run unemployment forecast can be thought of as an estimate by the FOMC participants of what they think the NAIRU is. And in the graph I'm about to show you, that looks to be around between 5.2 and 6%. The longer run inflation forecast represents an inflation objective, and given what we have stated starting last January, you'll see very clearly now that the FOMC view that annual PC inflation of 2% defines the price stability goal. So what does this SEP look like? Again, they'll talk more about it. I have the unemployment rate and PCE inflation here. Although you can't quite see it, the black line is the actual values of the two series. What you have here then is the range of reported forecasts by the 19 members, that is to say the 12 members, the 12 Fed presidents and the 7 members of the Board of Governors. And the range goes across all 19 of the forecasts. And then what you do is you throw out the top 3 and the bottom 3, and you get this interior region, which is sometimes referred to as the central tendency. What I simply want you to take away from it is, here's where we are right now. What do the members of the FOMC and the Fed presidents, what is their view of where they think the natural rate is? Well, again, between 5.2 and 6%. Notice this degenerate line at 2%, which is consistent with the 2% long-run inflation objective. The question to ask then is, how are we doing? Well, here's where we are, and I'm afraid the battery's running out. There's where we ultimately want to go on both fronts. So again, we're not in a position yet of getting close, especially in the unemployment rate, of achieving what our goal happens to be. Now, the last point I'll leave you with, again, much more will be discussed about this, is starting in December 2012, we introduced again, as part of our communication strategy, numerical thresholds. And the key point, I know I'm running out of time, however, is that we've tried to provide additional monetary accommodation through forward guidance. And previously, this forward guidance was date-based. But starting in December 2012, the FOMC moved to an outcome-based forward guidance based on the thresholds. Now, I want to read the following quote here, and again, there's a key takeaway point for this. The committee currently anticipates the Fed funds rate will remain in 0 to 1/4% target range, at least as long as the unemployment rate remains above 6.5%. You can think of that as projected inflation does not exceed 2.5% at 1 to 2 year horizon, and longer-term inflation expectations will remain well anchored. The one thing I don't want you to take away from this is that this is not a change in the dual mandate. All right? This is nothing more than an attempt to basically provide additional highly accommodative stance of monetary policy. We are not changing in any way our view that the long-run natural rate is 6.5%. We are not in any way allowing for the fact that PCE inflation over the long run can go at 2.5%. This is merely using the unemployment rate and inflation as a means to provide additional accommodation to, again, seek out the goals of full employment and price stability, which, again, is being defined as a 2% rate of PCE inflation over the long run. So the key takeaway from this, and I will finish up with this, is that these thresholds are not objectives. Okay? Again, they're a means to an end. They do not indicate a change in the dual mandate. These thresholds are serving as an intermediate benchmark to support a highly accommodative stance of monetary policy. And with that, I'll conclude my presentation.